and a $4 billion deal in the financial services industry fueled further takeover speculation. But will this be enough to combat credit concerns and declining housing market? That's just one of the questions we're going to ask our featured guest. As I said, Peter Schiff, president of Euro-Pacific Capital. He says, as I said, the United States economy heading into a recession, and says that credit issues do exist, but not just in the subprime mortgage market, but across all types of mortgages. Peter favors global markets in Asia and Europe and commodity-based economies of Australia and Canada. Plus, we're going to be joined by Jamie Sokalsky, of the CFO of Barrick Gold, and get more on that company's earnings. They were released last night. We're going to talk about gold hedging positions. That's all ahead on Open Exchange. Hello from Bloomberg World Headquarters in New York. I'm Pim Fox. This is Bloomberg's Open Exchange. We're going to hear more from our featured guest, Peter Schiff, in just a minute. But first, here are your top stories at this hour. Now, let's get some comments from our guest, Peter Schiff, president of Euro-Pacific Capital. Peter, welcome to the program.
Thanks for having me.
Can you put into perspective at least what you're seeing for the U.S. markets right now? We've seen a lot of volatility, particularly late in the day yesterday, a lot of seemingly buy orders coming into the market. We had a 5 billion share day on the NYSE. Is the market reaching a floor, in your opinion?
Well, I think it's more likely reaching a ceiling. But, you know, the market has been rallying in nominal terms for several years now, despite some rather disturbing underlying, very negative economic fundamentals. And I think a lot of those fundamentals are now starting to surface. We're starting to see the problems associated with consumer debt and mortgage credit. You know, we first saw the problems in the subprime sector. And people are trying to talk about, well, is this contagion going to spread? But it's not that anything's going to spread from subprime. The entire mortgage market is infected with this disease. It's just that the subprime was the most vulnerable, so that's where the symptoms first surfaced. But it's across the board. See, the problem over the real estate bubble, ever since the bursting of the NASDAQ bubble, and Greenspan, when he brought interest rates down next to nothing, and we ignited this housing bubble, a lot of people were looking to get rich quick in housing. And in order to do that, they committed to mortgages that they could not afford. They could probably handle the initial teaser rates, but they could not handle the reset. But people didn't care because they just assumed that real estate prices would rise, you know, in perpetuity. And so it didn't matter if they couldn't afford the payments. They were going to get rich by owning the real estate. And, you know, if you go back to, let's say, California, in the last few years, better than 80% of the mortgages were ARMs. These aren't subprime mortgages. I mean, everybody was using ARMs because there's no way they can afford to buy the houses if they had to get a fixed rate. Well, the problem is these mortgages are about to reset to levels that exceed the fixed rates that they couldn't afford in the first place.
But having said that, aren't you really talking about mortgages with vintage years of, let's say, 2004, 05, 06, and even 07? When you look at the overall housing picture, many people actually already own their own homes. Many of them are already in fixed-rate mortgages. And isn't this possible?
It's not just people who borrowed money to buy houses. A lot of people refinanced during this period. They refinanced into adjustable rate mortgages, and a lot of people extracted equity to buy second homes, investment properties, to remodel their kitchens, to take vacations. So there's a lot of extra mortgage debt on there. And when these interest rates were low, right, these ARMs enabled homeowners to have a low mortgage payment temporarily, and that freed up additional money for spending. But now that those mortgages are resetting, right, you're going to see, for most families, their biggest monthly expense, other than taxes, is their mortgage. And for a lot of families who have ARMs, over the next 2 or 3 years, they're going to see their payments go up by 20%, 40%, 50%. In some cases, they're going to double. And there's no way that they have the savings or the extra income to make these payments. And, of course, now that the lenders, the people who have been lending us all this money, are absorbing these huge losses and starting to realize that this paper is not worth what they think it is, that they've lent Americans so much money that we can't possibly pay it back. The lenders are not going to want to lend anymore. And when all that easy money is gone, all that cheap credit, no questions asked loans, real estate prices are going to plunge because the high real estate prices are merely a function of all this easy money, all this easy credit. And so when real estate prices collapse and all that home equity is gone, right, now all of a sudden Americans aren't as wealthy. They have to start saving again, and they don't have the cash to extract.
Okay, all right, Peter, hang on. We're going to take a break. We're going to obviously talk more about this in the hour. Hang on, we're just going to take a quick break. Let's take a look at the market. Now, let's go over to Robert Gray. He's standing by at the NYSE tracking the action for us. Robert, what's the talk today at the big board? What is the news that's moving markets?
Well, it's definitely volatility in a word, Pam. It looks like it's going to continue for a while. We're already seeing the S&P 500 giving back its gains. They had been inspired earlier by, of course, earnings that continue to come in well above the estimates of analysts. We're seeing earnings coming in at about 11% so far. Keep in mind, when the second quarter began, they were looking for less than 3% total. You see 2 out of 3 companies reporting are topping estimates, and traders like Ted Weisberg at Seaport Securities tell me at the end of the day, it is earnings that are going to drive this market. But of course, with this volatility being caused by the credit concerns, by the housing slump that you and Peter have been talking about, we're seeing that continuing to weigh down the market here, of course, and that's overshadowing the gains from the likes of Viacom. You talked about their earnings coming in, beating estimates earlier. Year to date, you see the stock is lower, but getting a boost in today's session. Walt Disney, similar picture there. And Starwood, of course, the third largest U.S. hotel company, second quarter profit falling less than analysts had been expecting. They also boosted their full year forecast that they had just given in April. So that is helping to send stocks higher. And another stock getting a boost today, Beazer Homes. Take a look at its 2-day trip. It plunging as much as 42%, the biggest drop ever for the stock yesterday amid trader speculation it was filing for bankruptcy. The company denying that yesterday. And then, Ken Griffin of Citadel LP playing the white knight once again. He's scooped up shares. He now disclosing he holds a 5.7% stake, up from just 3% before. And of course, Ken Griffin's name and Citadel have been in the news a lot lately, buying those distressed assets from Sowood Capital after their hedge fund collapsed, and also picked up some from Amaranth, as you'll recall, last fall after that hedge fund blew up. And we're seeing the rest of the home builders getting a bid in today's session, and we're seeing them bounce off 4-year lows, although, of course, investors should keep in mind a couple of weeks ago, there was that speculation that Warren Buffett was buying into the group, and we saw them bouncing up and then, of course, continued that slide afterwards. And my question for Peter is, looking at a stock and a company like Beazer under FBI investigation for possibly selling homes to people based on what how high their wages were going to rise, falling right into the category you're talking about. Is it still too early to buy into this group?
It's much too early. I think all these stocks are going to make the round trip. I mean, almost all the home builders, I think, are going to go down to about $5 a share. It's about where they were in 2000. The home building as an industry is pretty much dead. I mean, they built way too many homes, and they've got a lot of homes they can't sell, and they've got a lot of homes that they've sold to people over the last few years who really can't even afford them. So all those houses are going to come back on the market. So I think the whole industry is going to be dead for 5 or 10 years. I mean, there's no reason to build any more homes. We've built more than we need.
Peter, what do you make of the argument that people say, well, look, the unemployment rate is very low. It's 4.5%, and it's really whether people have jobs and whether they're earning a wage. That's what really drives the home market, and that as a result, what's going to happen is you'll have, obviously, this recession or the depression in the housing market, but it won't last that long because people will come back in with equity to actually buy the homes.
The problem is the jobs that we have are emanating from the housing bubble itself. All the extra wealth and consumer spending that has been made possible by home equity extractions, by temporarily low teaser rates, by the wealth effect. What's going to happen as housing collapses, all the jobs that were flowing from that extra spending are going to disappear.
So how come we haven't seen the unemployment rate creep up at all? In fact, it's actually been going down the last couple of quarters.
I mean, I can't explain a lot of government statistics, but, I think unemployment is ticking up. And I also think that for a lot of people in some of these bubble economies like California, much more income was being generated through home ownership than through employment. I mean, if you lived in a house and it was going up by $100,000, $200,000 a year, I mean, in many cases, people living in those houses only made $50,000 or $75,000 a year. So home ownership and home equity was far more important to their consumption than their jobs.
But that's only if they actually took out a home equity loan or they took out a loan against the value of that house.
They did. Or they, also when people had a decision about, well, should I save money or should I spend it? Well, when they look at their house going up, they said, well, why do I need to save? I'm rich because I own a home. All this is going to change. And I think you're looking at the cart before the horse when you're thinking that, as long as we have jobs, the economy is okay. Once the housing market collapses and all these mortgages go up, all these jobs are going away.
Okay, Peter, hang on. We're going to take a break. When we come back, as we've been discussing, Peter Schiff is negative on the housing market, but he does find some opportunities in commercial real estate. Find out what other sectors he likes right after this break. You're watching Bloomberg's Open Exchange. We're back with Peter Schiff, president of Euro-Pacific Capital. And Peter, as obviously you mentioned, you're not very positive on the housing sector. What about in some commercial real estate markets? Do you think that there is still opportunity there?
Sure, just not in the United States.
Where then?
Well, I'm investing in commercial property in Europe, in Asia, Australia, New Zealand. I like my whole philosophy. I wrote about this. I had a book that came out a few months ago called Crash Proof: How to Profit from the Coming Economic Collapse. And the principal theme of that book is that the U.S. dollar is on the verge of a major collapse. And if you look at a chart, you can see we're right at some critical levels. And so the idea is, in advance of the dollar's collapse, it's important that Americans protect their wealth. And a good way to do that is to own assets around the world that produce income, that have earnings abroad and can pay dividends in euros and Swiss francs and Singapore dollars and Australian dollars and Canadian dollars. And a very good way to do that is by buying into these commercial property trusts. Generally, we're able to find yields of around 5% on the low side, maybe to 7 or 8% on the high side, but in very high quality commercial and industrial properties. I stay away from residential real estate pretty much everywhere. I think it's a little bit expensive in most of the world, but I think America is unique in that our whole economy has been dependent on that real estate bubble. That's not really the case in other markets that have overpriced housing markets.
Step back and tell us why you think the dollar is going to fall further.
Well, the problem is, as a society, right, Americans just don't save enough and we don't produce enough. But we consume a lot. And what we're doing is we're consuming what everybody else produces, particularly in Asia, and then we're borrowing the money from them to pay for it. So we're flooding the world with, every year with dollars, with $60 billion trade deficit a month. You've got these sovereign wealth funds that are blowing up all over the world where, the Chinese have, trillions of dollars, and the OPEC nations and Japan and European nations are accumulating all these dollars. And there's nothing for them to spend them on. We don't manufacture enough products so that we can export those products, and give our creditors something to do with their dollars. So they've been accumulating, and eventually, right, all that supply of dollars globally is going to send the exchange rate collapsing. Now, recently we've seen the dollar hit 26-year lows against the pound, against the Australian dollar, all-time lows against the euro. We're very close to a major support level on the dollar index, which is around 80. And I've been forecasting that we'll break 80, and
Peter,
the dollar will be
I'm just
cut in
going to
half.
interrupt you for just a moment because we were going to do some news in the moment because there's a deal that went down today and we want to talk more about it. Welcome. If you just joined us, I'm Pim Fox. You're watching Bloomberg's Open Exchange. Our featured guest today is Peter Schiff. He is the president of Euro-Pacific Capital. More from Peter in just a few minutes. But first, let's take a check at the benchmark stock indices. Let's look at the Dow Jones Industrial Average. It is up more than 44 points. The S&P 500 up a little bit more than a point, and the Nasdaq gaining 8 points. Now, Barrick Gold reporting a 14% drop in earnings for the second quarter. Earnings fell because mining costs rose and the company shed some hedging contracts. For more on these numbers, we're now joined by the company's CFO, Jamie Sokalsky of Barrick. And, of course, we still have our featured guest, Peter Schiff, president of Euro-Pacific Capital. Jamie, welcome to the program. Thank you for joining us from Toronto.
A pleasure to be here.
Jamie, can you just give us some idea of where the cost increases are coming? I've noticed that the waste issues related to some mines, I believe, in Nevada, and also some currency issues. Can you just elaborate on that, please?
Sure. Well, we really had an excellent quarter. Costs were up, but that's really because of mine sequencing issues that we have. As we're progressing through some of our larger mines, we're hitting some lower grade waste stripping, and that's really the largest reason why our costs are up. And so overall, we're very pleased with the performance. There's some currency issues in terms of our Australian mines. We've got a lot of hedges to protect, but those hedges were at slightly higher levels, so that added a little bit of pressure there as well. But overall, we're very pleased with the cost containment that we're seeing in our operations.
Jamie, can you give us a little bit more detail on the production? It looks like production was down about 6%. Is that going to be consistent throughout the entire second half of the year?
Well, we reaffirmed our guidance with the release of the quarter, similar to the first quarter, both on the production and the cash cost range. Production really was in line with where we thought it was going to be. We're still looking at a range of production for the year of 8.1 to 8.4 million ounces. So overall, I think we're still well on track to meet the guidance on both the production and the cash cost numbers that we put at the beginning of the year, which I think is pretty unique in the industry given a lot of the cost pressures we're seeing.
Just a comment, and first, congratulations on a good quarter, and I say that as a rather substantial shareholder, both personally and for my clients. But one of the things that's been interesting about the performance of gold stocks, and a lot of my clients who own these stocks get a little bit frustrated, is that they seem to be very correlated right now with the stock market in general. Rather than gold and gold shares moving inverse with the market, it's more like they're acting as liquidity. When do you think you might see gold again, reemerge as a safe haven when money is scared, when people are fleeing bonds and stocks, that instead they go into gold, and we might start to see gold stocks rise when other stocks fall?
Well, I think there's more than enough reasons for gold to continue to move in a counter-cyclical way to the broader equity markets. I think there are geopolitical issues. The U.S. dollar has a huge impact on the gold price. As the dollar falls, gold goes up. So I think we're coming upon a period when we're going to see higher gold prices and gold acting as that safe haven, as the negative correlation to the gold market. So I think that's coming fairly soon, and we're very poised to increase our margins quite substantially as a result of that rising gold price.
Jamie, you still have some hedges. About 9.5 million ounces of gold seem to still be hedged. What's the reason for that? Is it hedged to a specific project, and can we see those hedges start to come off anytime soon?
Well, we've done a great job of really eliminating all of our corporate sales hedge book so that now our operating mines are fully unhedged and allow us to fully participate in a rising gold price. And we're seeing that, and that's reflecting in the earnings. The project hedge book really is a position that is allocated towards project financing for a number of our very large projects that are going to hopefully come on stream starting in 2010 onwards. So they're backstopping project financing, which the banks are going to want as security against that financing anyway. So that's going to provide us with better financing and cheaper financing to develop projects going forward.
Jamie, tell us a little bit about currency risk and what that's doing to your operations. If you look at the actual price of gold in terms of euros, it hasn't budged very much, at least compared to what it's done against the U.S. dollar. Tell us, what's the effect of a weaker dollar for you?
Well, a weaker dollar has generally always resulted, particularly over the last 5 years or so, in a higher gold price. And so that's good, obviously, for our operations. About 70% of our production is denominated in U.S. dollars, so as the U.S. dollar declines, it's really not going to have a big impact on our cash costs. The 30% or so that's not in U.S. dollars, we're almost fully hedged for the next 2 or 3 years, and so a dropping dollar, good for the gold price, not going to have really a significant impact on our costs. So overall, it's a big positive for the company.
Tell us about any of your acquisition or strategic plans. Any plans to take over any more companies?
Well, we're always looking around to improve the portfolio of the company. We're very disciplined in terms of what we look at. We want high-quality assets, and overall, it's something that has been the way we've grown the company in the past. But things are expensive, and we're not going to grow just for the sake of growing in terms of production, but we're going to grow in terms of earnings, cash flow, and those are the types of situations we're looking at. There's nothing to really talk about at this point.
Jamie, you talked about cash flow. The cash flow has been doing very well at the company. Any plans to increase the dividend to shareholders?
Well, we just did increase the dividend in the first quarter by 36%. We're generating very strong cash flows, got a great cash balance. We're the only A-rated company in the gold industry in the world. So we increased the dividend, and as we continue to see hopefully very strong cash flows, that's something we'll continue to look at, and hopefully we'll be able to do more of that.
All right, thanks very much, Jamie Sokalsky, the Chief Financial Officer of Barrick Gold, talking about the results of Barrick Gold. Up next, crude oil prices hit a new record yesterday before retreating somewhat, but could prices go even higher? We'll find out why Peter Schiff is looking for $100 a barrel oil next year. He also is predicting a recession here in the United States. Find out why when we come back. You're watching Bloomberg's Open Exchange. Welcome back. I'm speaking with Peter Schiff, president of Euro-Pacific Capital. And Peter, let's talk a little bit more about oil and commodities. You've written that you think oil is going to go to $100 a barrel, and that we could even see $150 to $200 a barrel oil.
Sure.
Why is that?
Well, first of all, I've been accurately forecasting the price of oil for the entire move. I mean, I was talking about $50 oil when it was 20 and then 70. So I've been right on it. But what's really happening in many respects is oil is not becoming more expensive or more valuable. It's the dollars that we use to buy it with that are losing value. And so since our money is losing value, we need to give the oil producers more dollars to compensate them for the loss of purchasing power of our money. And if I'm correct on what I think the dollar is going to do over the next few years, I think its value is going to be cut in half. That means oil prices will have to double just to make up for the loss of value of the dollar. And, I can see a situation where in a few years, oil prices are $150 a barrel or more here in America, but in countries like China, that will actually represent a reduction in the price of oil. Because I think if you see the Chinese yuan dramatically appreciate against the dollar, which I think it will, at the same time oil is getting more expensive for us, it's getting a lot cheaper for the Chinese. And as a result, they're going to consume much more of it. And we're going to have to consume a lot less.
So how do investors profit from this if oil is still denominated in dollars? We had some rather small moves for some countries to actually trade oil in euros and so on. So how would an investor profit?
It's not denominated in dollars. It's priced in dollars. It's priced, right. I mean, so a dollar-denominated investment would be something like a retailer or a bank in the United States that earns its income in dollars. You want to avoid those kind of companies. But if you earn your revenue by selling oil, you're selling it in the global market. So if the dollar collapses, oil prices will just rise. So the way you benefit from that is, of course, you own oil companies. And I think many oil stocks are still inexpensive. I think they still don't reflect all of the upside in oil, particularly some of the foreign stocks. I still find much more value. If you want to go to Australia, if you want to go into Asia, you can buy oil companies for much better, lower multiples than you can in the United States, even though the U.S. ones are still not that expensive, and you can get better dividend yields.
Any preference on whether you're talking about oil, integrated oil companies or oil and exploration companies? Is there
there's more speculation there, the exploration type plays. But one of the other reasons that I like the foreign oils is that, whenever the oil price really goes up here in the United States, the politicians are always talking about a windfall profit tax on the oil. And I never see that in some of the foreign markets we're involved in. So if I'm going to be invested in an oil company, I don't want to do it in America where the minute we start making any money, the U.S. government is going to try to seize it.
So what about some of the other commodities, the industrial commodities, for example, even coal, for example, but what about iron ore, copper?
We've got big positions in zinc and nickel and lead and, and a lot of these stocks, I've been buying them for years, and they're paying good dividends, and we're getting very good appreciation. And again, a lot of this is a function of inflation. It's not that rising metals prices are causing inflation. They're resulting from the inflation that is being created by central banks around the world, particularly here in the United States.
So what do you make of the Rio Tinto results? They came in, it was one of the first times in 4 years that they actually said the profit fell, mainly because of lower copper production and also because of slower coal sales in Australia.
Well, I haven't had a chance to look at it, but anytime one of these companies stumbles, the idea is to buy it. I think we're still in primary bull markets and commodities, and I think people should be exposed to these sectors, and
So do you think that the global economic growth is going to continue apace despite what happens in the United States?
I think ultimately there's going to be a major decoupling. People still are confused. They think that America is the engine that drives the global train. We're not. We're the caboose. And in fact, we're dead weight. And as soon as the rest of the world can sever that caboose, the rest of the train will move a lot faster. And I say that because what we're doing is we're just consuming and borrowing. But the real productivity is in producing goods and saving money. What we're doing isn't so special, just consuming things. There's nothing that prevents the Chinese or the Japanese from consuming more. Anybody can do. That's the fun part. The only reason that we're consuming...
Well, indeed, isn't that what the Treasury Secretary Henry Paulson is trying to encourage the Chinese to do, to stimulate domestic demand?
Of course, if the Chinese allow their currency to rise, that increases the wages of their own citizens, it increases the purchasing power of their own citizens, and now Chinese workers, instead of working all day in factories and then watching the products that they produce get shipped to America, they'll be able to buy those products. They'll be able to afford them. But what he doesn't understand is now we won't get them anymore. When the dollar collapses, all the factories in China are still going to produce goods. They're just not going to be sent here anymore. The Chinese are going to enjoy them, and we're going to be left with nothing because all of our factories are gone.
Well, when you talk about inflation and you talk about what's happening with the dollar, don't you expect to see that also happen with, let's say, soft commodities like wheat, for example? That is something that the United States can produce.
All commodity prices are rising, and wheat prices, corn prices, sugar prices. They're going to keep rising. They've risen certainly far faster than the Dow has over the last 8 years. But when the dollar collapses, those prices are going to go up. And what's going to happen is more of our agricultural, production is going to be exported because consumers in the rest of the world are going to be a lot wealthier.
Okay. All right. Hang on, Peter, because there's more. We're going to get some more thoughts from Peter Schiff of Euro-Pacific Capital and find out why he likes some of the European markets. Stay tuned. You're watching Bloomberg's Open Exchange. Look forward to it, Brian. We're back with Peter Schiff, president of Euro-Pacific Capital. He's been our guest this hour on Open Exchange. Peter, talk a little bit about the European markets. You mentioned it briefly in the first half. Do you think that the European markets are the place for people to be investing?
We've got a lot of exposure in Europe, both in the countries that share the common currency, the euro. I also have investments in Scandinavia, in Sweden and Norway. I've got money in Switzerland. And I think that the euro in particular is going to be the primary beneficiary, at least in the short run, of the collapse of the dollar. And I think a lot of capital is going to move into Europe. I think the strengthening euro is going to help keep interest rates and consumer prices in check and really help the European economy. So I look at, a lot of the flight money that's going to leave the U.S. and leave the U.S. dollar is going to find a home in Europe.
When you look at Europe and you look at the euro, as you just described, does the increasing value of the euro, let's say against the yen particularly, does that at all play into their ability to continue to be a strong export
market? Well, ultimately,
I
expect the yen to reverse that direction. Maybe we're starting to see that, but the Bank of Japan has been pursuing this kamikaze kind of monetary policy, I think, in order to keep the U.S. dollar propped up. And I think eventually they're going to give that up and allow the dollar to sink, and that will take a lot of pressure off the Bank of Japan. They'll be able to let rates normalize and allow their currency to appreciate.
And do you think that that's an area that people can profit from? Should people be going long the yen right now?
Probably, but we don't have a lot of exposure in Japan. I've been a little nervous about what they've been doing. I'm guessing that they're going to come to their senses, but I don't know that for a fact. So I really have avoided it. I've preferred countries like Singapore and Hong Kong to get exposure to that part of the world.
Well, what about you talked about being a little bit nervous about the Japanese economy, but what about the U.S. economy? You're more than just nervous about the U.S. You're predicting a recession, correct?
Our economy is a mess. It's a basket case. Yes, we're going to have a severe recession. Our phony economy that we've had, again, has been this bubble based on consumers borrowing money from abroad and buying imported products. And we've run up a multi-trillion-dollar debt. Meanwhile, all the economists and Wall Street strategists point to our GDP as evidence that our economy has been growing. All that evidence is how much we've been consuming. They ignore all the debt that we've piled on. This is not legitimate economic growth. This is just, a consumption binge, and now we're going to have to pay for it. And we've had a lot of malinvestments during that boom. We're going to go through a recession. This recession is very necessary to purge all these imbalances out of our system, out of our economy, and restore the economy to a more balanced economy that is driven by savings and production. But there's no way to get from where we are to where we need to be without a significant recession. And it's going to be very painful. It's going to last a long time. but it's necessary.
When do you see it materializing?
You know, I think it's already started. You know, there was a poll that came out today conducted by Wall Street Journal, NBC, and it showed that 2/3 of the people surveyed believe that we're either in a recession or headed for one. And a lot of people on Wall Street are confused. They think there's some kind of disconnect between the people and how great the economy is. But the reality is there's a disconnect between the government numbers and how rotten the economy is. I think if the government was using accurate measures of inflation and a more accurate measure of GDP, the numbers would show we're in a recession right now. And so I think the public understands this. They feel it. They see the cost of living rising. They know their paychecks aren't keeping up with it. They see they're struggling to make their mortgage payments. They're watching their home equity evaporate. You know, it is a recession in every place but Washington and Wall Street.
All right. Well, we're going to have to leave it there. Thank you very much, Peter Schiff of Euro Pacific Capital. Thank you for your views.
Thank you.
Stay with us. We're going to get some final thoughts. No, we're not going to get some final thoughts from Peter Schiff. Oh, I beg your pardon. We do have more final thoughts from Peter. He's going to be even more. He's going to be gloomier when he comes back. Well, we'll see. You're watching Bloomberg's Open Exchange. It's 51 minutes past the hour. My apologies, Peter. Welcome back. Peter Schiff, president of Euro Pacific Capital, has been our guest this hour on Open Exchange. And, Peter, you have actually generated some viewer interest. I have a message here from Todd Senek from Dallas, and he's writing in, and he wants to know that you talking about home builders. Remember you talked about home builders going to $5 a share. Is this not all home builders are going to go to $5 a share. This is what he contends, and would like to know where this information is coming from, and how do you arrive at that number? And that's a very good question.
Look, if you just look at a chart and you see where all these stocks were for maybe the 5 years between 1995 and 2000, that's about where most of them were. And then they all took off and they went up to $70 or $80, and now they're all down in the teens. I mean, it's just a natural place for them to stop. I don't know. Some of them might go to 0. Maybe some of them might only go to 8. I don't know. But I would not go anywhere near that sector.
Okay, but granted, you won't go anywhere near the sector. But do you have any financial data that tells you that the stocks, on your analysis, are going to go to $5 a share?
No, you just have to pick something that you think. Just look at a chart. That's where it looks like it makes sense for me to believe they're going to go. And I've been saying this, by the way. I've been saying $5 when they were at 60 and 70. So it's not like this is something new. And, the whole U.S. stock market, the home builders are a great example. A year ago, when people were looking at these home builders and they were trading at 6 and 7 times earnings, and they were trying to make a case that they were cheap and they were a value, I was on shows like this saying, what, are you kidding me? These companies aren't going to have any earnings. They're going to have enormous losses. These earnings estimates are phony. And the same thing is true about the U.S. market today. People are talking about the S&P 500, and they're talking about how it's at a very low multiple relative to its future
15,
earnings.
16 times.
Yeah, these earnings are pure fantasy. They're just as real as the value.
But how are they pure fantasy even when you look at companies, let's say, buying back their shares?
Look, they're just as real as the value of the subprime bonds and those Bear Stearns hedge funds.
But how do you make that connection?
Because they're assuming that the economy is going to be growing when it's in a recession. They're assuming interest rates are going to stay low when they're going to rise. These earnings are not going to materialize. A lot of these companies, particularly in financial services, aren't going to have earnings. They're going to have staggering losses. And so the S&P is actually very expensive based on what they're really going to earn. It's only cheap based on these phony fantasy numbers that the analysts are attributing to.
But the fantasy numbers, they actually have come in to become reality, right? If you actually look at what happened in the second quarter S&P 500 earnings have actually exceeded analyst estimates, correct?
I'm not talking about the past. I'm talking about in the future. Stocks are trying to price future earnings, and we are headed for a severe recession. We're going to have a lot of unemployment. We're going to have a lot of, foreclosures and bankruptcies, and interest rates are going to go up, and inflation is going to get a lot worse. And in that environment, these rosy earnings estimates are not going to pan out, just like they didn't pan out for the home builders.
So what about, for example, companies that rely on the very wealthy, for example, Toll Brothers? They produce homes that are in a very different category than other
all the homes are going to
companies.
go down. For the wealthy, for the middle class, there's no reason to go anywhere near that. The only American companies that are worth owning, if you're going to own them, are going to be those companies that are exporting. Those companies that are going to be able to take advantage of wealthier foreigners, not the ones that are going to be dependent on poorer Americans.
But what do you make of the argument that there are a lot of foreigners coming to the United States to buy up assets here because they're cheap?
And they're going to get a lot cheaper. You know, and yeah, eventually foreigners are going to steal a lot of assets right out from under us, but that's nothing that we should be proud of. That the fact that, you know, somebody in Europe is going to be able to take their allowance, a little kid is going to take his allowance and buy a condo in Miami because Americans can't afford them.
All right, well, we're going to have to leave it there. Thank you very much, Peter Schiff. Appreciate your coming in from Euro Pacific Capital. Thank you.
Sure.
Thanks for joining us.